Welcome to C2 Biz Growth Iron Sharpens Iron podcast, where CEOs and entrepreneurs share how they are overcoming business growth and sustainability challenges.
Welcome to C2 Biz Growth, where iron sharpens iron. I'm your host, John Hale III, and welcome. And we are excited today to have with us Brett Sharenow. Brett is the CEO of Broadscope, and we're going to dig into his journey from Long Island, New York, from building car engines to Silicon Valley, to helping building businesses, and in the process raising over $120 million in early stage capital. Welcome to the show, Brett. How are you doing today?
Great, John. Thanks for having me. I'm doing really well. Thanks.
Good. Hey, we're glad you're joining us today. We just wanted to jump right in here and just understand and see how you're showing up today as a CEO. You've been at this, I believe you said 30 plus years. And we just want to get a sense from your journey, what experiences from childhood or family or early in your career really impacted you today as a real successful CEO?
Thanks, John. I think one of the biggest that impacted me when I was growing up in New York, about 10 years old. And There was a mechanic that lived up the hill from my house. It was a small town, 500 people. And he was one of those old time master mechanics who could put his hand on an engine and tell you what was wrong with it. And I used to hang around with his son playing football and that. And one day I was at the garage watching him and I was fascinated. And I started hanging out at the garage pretty much every waking moment from the time I was 10 until I left New York at 19. So by the time I was 14, I was actually rebuilding engines. He was an amazing man. He could really get a sense for what was going on technically with anything he was working on, whether it was a car or a truck or a tractor. Brother owned a farm in upstate New York, but we also used to work on televisions and radios and dishwashers and the old tube television sets.
Wow.
So I'm going back a little ways, but
Yeah, a couple of years.
But his ability to look at a problem and how to fix it was what I really appreciated about him. And that experience got me to a place that I now call I get into the zone, where the rest of the world goes away when I'm working on a problem, whether it's a car or a business, doesn't matter. And I have a sense for, okay, these are the details, and the details are great, but I also have to be able to get above the details and get into the strategy and be able to go back and forth between the two regularly to help figure out what's going on and what direction we need to take to make whatever we're working on be successful. And that's what my work with him taught me. By the way, his name was Joe.
Okay.
And just an amazing mentor. And I wouldn't be where I am today without him.
Incredible. And so when you were working on these car engines and tube TVs, as part of your growth or development, what was the biggest challenge or growth that you saw within yourself, I guess, during those years from 14 to 19?
Great question. I think the biggest thing I got out of it was from the time I started until the time I ended working with him, I got a sense in myself that I could essentially work on anything and be successful. So it was partly, I use this and I don't want to be woo-woo here, but it was partly connecting with the universe. And when I would get into something, even though I had never done this before, I'd never rebuilt this Holly carburetor, but I knew from the work I'd already done that I would be able to do it. So I think the biggest thing I got out of it was perseverance, that I knew if I stuck to something, no matter how hard it was, I would get to the other side. And it's funny now that I said that because my second mentor in business, I'll get to him in a minute, once said to me, we had been working together 5 years. I had gotten into a really rough spot in consulting and probably the hardest, most challenging part of my career to date. And I got done with that, worked through it, took 3 months, and we had to sit down about once a quarter. And he came to me and he said something like, if you knew consulting was going to be this hard, would you have started in it? And I looked at him and I said, Lynn, I don't actually know. And he said, well, let me tell you something. He said, I've worked with, grads from Harvard and Stanford and Penn, and I would much rather work with somebody that could persevere and get their way through it rather than the smartest person in the room. Because That smart person in the room hits a roadblock and they typically crater. You don't. You put your head down and work through it. So I think perseverance was one of the biggest things I learned from Joe.
Well, thank you for sharing that. And that's an incredible story. Having watched my dad work on cars and, rebuild engines, rebuild parts. And the funny story I had was I was out with him in the garage. I was in middle school one time in the winter back in Michigan. So we worked in the garage and he was all done. And I was kind of watching him. I'd grab this, grab that. And he looks on the ground. There's like 3 or 4, a couple screws and a valve or two there. And he says, "Don't tell your mother." The car works. I was like, "Okay, good. We're going to watch the football game now." He said, "Don't tell your mother." Not
Yes.
nearly the great perseverance story that you shared with us.
Extra parts are not typically very good. No.
Not very good. Not very good.
Yep.
So you had mentioned Lynn, and I wanted to kind of segue now to your mentor Lynn, and then how you got to start Broadscope, and if you could just describe what Broadscope does, and then get a sense of its products and services, and what challenges does it solve for its clients.
Sure. So after Joe, college degree in chemistry, was a chemist for a few years after that. I liked the lab. I liked working with my technicians, but it was too insular for me. I really wanted to be out in the world. So Rogers Corporation, where I worked, created a product marketing role for me. I did product marketing for a while with the products that I had developed in the lab. So technically I knew what was going on, and then it was relating with the clients and all that. And then MBA. And I started my MBA in Arizona and then moved to the Bay Area. And I was working at a startup as a sales manager and was then promoted to director of marketing and sales in the middle of my MBA. My first MBA professor in Northern California was a gentleman named Lynn Morris. And Lynn had been a partner at Maricon Associates. And Maricon was at the time and still is today a really wonderful boutique consulting firm. And I say boutique, but it was really known by the Fortune 50. And Maricon was one of the first firms to actually value a business strategically. So they were literally using the old punch cards that you probably remember and coding the company to figure out if we make a change, for example, in the sales force, does that increase or decrease the value of the firm? And I met Lynn in a course called Strategic Financial Planning. And I knew after the second or third night of class that I wanted to work with this guy. And the reason is that this was the first person I had ever worked with who was able to put together all of the disparate pieces of a business and how they fit together as a whole. So what do I mean by that? Sales, marketing, finance, accounting, human resources, to be able to see all those pieces from a strategic level and how each one of them fit into operations of the business and business valuation. I was really blown away. As it turns out, about 4.5 years later, of course, I had stayed in touch with Lynn after I graduated. I got the opportunity to work with him. It was a project for Pacific Telesis. It was supposed to last 2 weeks. He called me and said, I've got a 2-week project. Are you interested? I said, to work with you? Yes, of course. Well, that 2-week project turned into 10 years working together. And, say I've got my MBA, but my MBA doesn't let me do what I do today. What lets me do what I do today is my experience in the garage with Joe, my ability to figure things out, my technical ability there. What I learned from Lynn about how to consult, because I've learned and realized that consulting is a business unto itself. So to be able to work with him and understand, what does it take to work with a client? What does it take to work with the board? What does it take to work with customers? What does it take to work with investors? All of that came into play. And after the first year or so, we were working with Fortune 50 companies. The dot-com boom started, and we were grabbed by the EVPs and CEOs that we were working with in the Fortune 50s because they were going and moving into startups. So we were brought in to help them with business strategy, capital raise strategy, financial modeling, pitch deck, pitching, raising money, and then eventually exiting. And I did that for my last eight years working with Lynn. He then retired and I've continued on. So I've got 35, 36 years of experience now raising money, mostly from venture capitalists, although some angel, some private equity, some strategics, and some family offices. And that's what I do at Broadscope today. I'm really a master at raising capital for, let's call it startup to IPO companies. So what does that mean? I typically start at the Series A round, which is the first typical preferred round of shares that get issued that are typically funded by venture capitalists. So $3 million and up. And I go all the way up to IPO. I did an $85 million round last November. and I'm in the middle of $100 million round right now. So anything in there is fair game for me.
Fantastic, fantastic. And as we get started in our conversation, a couple terms get thrown around just from an industry standpoint a lot to make sure that our audience and CEOs specifically understand it from a practitioner standpoint, someone who's out in the market raising money. What's the distinction between private equity and venture capital?
So I'll take a step even further back than that because it's important, I think, for the audience to understand. When you first start a company, normally it's either bootstrap, you put your own money in as the founder, or you raise what's called friends and family. And friends and family are people that may not know anything technically about what you're doing. They may not know anything about your widget at all, but they see that you as the founder are really excited about your widget, and you can explain to them in reasonably simple terms what's happening and what you're doing. And they are betting on you as a person. They know you, they like you, and they trust you. So that money is going in from friends and family because of that, not for technical reasons or the market's big or what the exit strategy is going to be or anything like that. The next tier up is typically high net worth individuals and angels, and they're different. High net worth individual is typically a person who either exited a company or is independently wealthy or generational wealth came to them and they have money, but they're not necessarily out in the marketplace trying to invest it. But John, you know them. You know your friend Sally is a high net worth individual, and you're talking to her one day at lunch and you tell her about what's happening. And she says, wow, I'm really interested. Are you taking investors? And you say, yes. So that's that high net worth individual type. Angel investors are high net worth individuals that also are in the market to invest. So their business per se is they are out looking for startup companies to put money in. The next tier up is typically family offices, high net worth families usually, who are trying to diversify their portfolio, but in a specific market segment. So somebody who's in the packaged food business, that's a big company, and they want to diversify into other packaged foods, they might form a family office to invest in other packaged food businesses. The next tier up addresses the first part of your question, venture capitalists. Venture capitalists are firms that are formed, corporations, that take money from limited partners. These are hedge funds and other groups of people who have lots of money and invest in the venture capital firm. The venture capital firm is then taking that money and investing it in specific domains that they have told the limited partners they have expertise in. So it could be semiconductor technology, it could be AI, it could be artificial and virtual reality glasses. But essentially, they're taking that money, investing it, and then when those companies exit, they are providing returns to the limited partners. And therefore, that's how the limited partners get the kinds of returns that they'd like to see. And it's also what justifies to the limited partners for the next round the venture capital wants to put money in. Venture capitalists normally start off around that $2.5 or $3 million range and go up to, let's just say, $100 million. There are deals above that, but that's the typical venture capital range. Now, private equity are firms that are also corporations that have money put into them, and they are typically looking at investing bigger chunks of money, 50, 100 million and up typically. And a private equity firm is normally looking for a company who's got a reasonably successful product, but maybe the company's not operating optimally. They don't have the right people or systems or that kind of thing. And a private equity investor looks at this company and says, wow, with my team of people, if we put money in, I can bring my people in who have the expertise in accounting systems and finance or sales and marketing or whatever it is, turn this company around and have them be dramatically more successful in a 2 to 3 or 4 year period, and then flip or sell the company after that and get out. So private equity investors are typically in it for a shorter term time frame than a normal venture capital investor is in. A VC investor of 5 to 7 years is pretty typical. Okay. COVID has actually lengthened that time a bit because things have taken longer to materialize.
Understood. Well, thank you for that explanation. So it gives our audience, particularly our CEOs, a nice breadth of the type of investors that are available for them as they're seeking to raise capital. And so some research I did, I found out, Brett, that 1 in 1,282 high school football players make it to the NFL. And according to the Angel Capital Association, approximately 0.05% of startups receive VC funding. Very, very small number of companies. In your experience, how can CEOs increase the odds of receiving VC funding?
So there's a number of things that go into the camp of how can you be successful at raising venture capital money.
Okay.
Many companies get friends and family, and many companies can get angel money. But that first venture capital round is a very big hurdle. And it's because venture capitalists are what are called sophisticated investors. They've been there, done that a lot, and they can sense in a relatively short time that the product or service has the potential to be big, that the CEO who is talking to them has the potential to make this thing big. So what does it take? It takes a few key pieces in order to raise venture money. The first is what I call the 3 C's, the compelling case for customers. What I mean by that is, let's say we were the first company to invent these things, AirPods, right? This is an AirPod case. The investor that's putting money in wants to know that this thing is so compelling. And by the way, I just saw you've got a pair in too. This thing is so compelling that people literally want to rip it out of your hands and pay you what's necessary for you to be profitable for this. Now, most founders, when they come to me with a product or a service, they can't define the compelling case for customers. They can tell me all about these things, the microprocessor chip that's in here and the battery life and how long it's going to take to charge and what the output frequency response is and all of those things. But that's not what convinces investors to invest money. What convinces investors to invest money is their emotions. They get excited about what you're doing. So part of the thing I work on with my clients is I have to help them tell a story that is so exciting that investors are literally leaning in and wanting to know more before the CEO is ready to tell them about that. So that's the first thing, compelling case for customers. The second is they have to have a business strategy that also holds water, that all the components of the business strategy work. What's the product? Who are you selling it to? How are you going to reach the client? How are you going to increase revenues faster than expenses and capital? That's called scaling the business. That's critical. And then the investors want to see that you understand your capital raise strategy. How much money do you need in the current round? Which most investors can tell them when they go in to present. What most founders don't do well is they don't think about the follow-on 2 rounds. And investors want to know that the CEO has already thought about how much they want to raise in the next round, when they're going to need that next round. So they raise money today. Are they going to need that next round in 12 months or 18 months or 24 months? And most importantly, what milestones is the founder going to reach before they try to invest the next round? Now, why is that important? Founders ask me that all the time. Why do I care about the next round? Well, the reason is because if you're coming to me for money, let's say you want $5 million for this round, I need to be reasonably confident as an investor that you're going to be able to raise the follow-on round for you to be successful, right? Because if you can't raise the follow-on round, then my money is going to be stranded and you're going to go bankrupt. So I'm looking at not just today, but where are you going? Are the milestones that you're telling me you are going to reach significant enough that the next investor in the B round, let's say, sees a good value for the business, that there's going to be a step up in valuation, which means that the value after the money comes in, it's called the post-money value now, and the value of the pre-money before the next round comes in is about an X increase. So the investor's saying, okay, is this about a 2X step up in value from now until 24 months from now? And if they believe that and believe your story and are excited, they are going to be much more amenable to giving you money. So we've dealt with the strategy side. Now, the 2 things we haven't dealt with yet are the financial forecast, because the investor wants to see that you've built a financial forecasting model in Excel that models the business by month from now out 5 to 7 years. And they want to see not that the numbers are right. Founders ask me this all the time. I can't model that. I don't know what's going to happen in 5 years. The numbers are wrong. And I look at them and I say, of course the numbers are wrong. And of course the investors know that the numbers are wrong. They are looking to see, have you thought about all the details that they know you are going to encounter so that you've planned as best you can right now for what's coming, and that you've got a model that's flexible enough so that if an arrow comes in from out in that direction, you can either grab it if you're really fast and throw it away, or move out of the way, or put up a shield, or do something that allows you to deal with all of these changes that are happening. They want to understand that you can do that as a CEO. They're not looking for Mr. or Mrs. Perfection. They're looking for somebody who's humble. They're looking for somebody who knows that they don't know everything, and they're going to learn as they go through the process. And then lastly, you have to have a very compelling pitch deck, and you have to have a very compelling pitch. The difference is the pitch deck or the slides. The pitch is the talking that you're doing to the investor, which may be on Zoom. It may be in person in Menlo Park or New York or wherever you're going to be pitching, or actually maybe at a cocktail party or a coffee shop. You run into somebody and you've got 30 seconds to tell them what's amazing, not to get an investment right there. It doesn't work that way. You want to basically have them say, it's really exciting. Would you come in and present your deck to me and my team next week? And your answer is, of course. When? You need all those things. And then to address your question just a little bit more granularly, COVID has made it more difficult to raise money, not less. And the reason is COVID has caused things to take longer to happen than was originally forecasted pre-COVID. And because things take longer to happen, many startup companies are running out of money. They've had to go back and raise money earlier than they would have wanted to in their life cycle. And it's caused investors to be leery. There are also fewer companies that are exiting, either in a mergers and acquisition or an IPO transaction. So that also makes investors more leery. So it gets back to the thing I said at the beginning of this section. You have to get the investors emotionally excited about what you are doing. Investors are really, really amazingly smart people, but they're also human. So you must speak to their humanness first, get them excited. Their intellect and brain will then take over to convince themselves that their excitement is right for this startup and they want to put in money.
Thank you for sharing that, Brett. That was really awesome. And particularly, in the sports season, it's like the metaphor with putting together the pitch deck and particularly thinking about the follow-on rounds. While most CEOs are thinking about what's right in front of them, the capital is thinking about how do I get additional capital, and then how do I exit? That's their ultimate pay, get paid back. So it's kind of like that follow through in a baseball swing, golf swing, jump shot, whatever you're doing, in sports, you got to have the follow through to nail it. So thank you for sharing that. That kind of brings me to the next question. According to the National Venture Capital Association in 2023, number of VC exits are the lowest in a decade. And so what are the implications for CEOs and companies seeking funding? I know you started to touch on this towards the end of the last response.
Yeah, it actually brings up exactly where I ended that last section. The NVCA has data, of course, from all the exits and what happens. And fundamentally, as you just said, many fewer companies have exited over the past few years. And again, the reason is it's taken things longer to happen. And that's not a good thing for a company that wants to exit. But in addition to that, if companies continue to get funding, they can continue to build the business if they have a profitable business and postpone the exit even further. Now, advantages and disadvantages. The advantages is that hopefully the eventual exit will be larger because now you've got more revenues, more profit, and the company looks more attractive to either the IPO market or to an M&A transaction. That's great. The problem is, though, that people who have put money in, whether it's investors who have put direct money in, or whether it's employees who have put sweat equity in and they have options in the firm, those options are not exercisable because the shares are not traded in the public markets. So you can't trade those shares. And what a lot of companies are running into is founders and some early investors who want to get some of the capital out, but now the process has lengthened. So, what happens at that point? Well, either the company has to exit or the company has to raise money as a secondary, which means that some of that money is going to go to pay off some of the initial investors or give some money to some of the people who have options in the company or warrants to give them some value because they've been waiting for a while. But all of that, as I said earlier, makes it more challenging, more difficult to raise in the current round. So what does that mean you have to do? Well, there's still a lot of money out there, but as I said, investors are more leery to invest, more wary because it's taking longer to exit, and they're being much more selective. So you can still get money. I raised 2 large rounds last year, a 14 million and an 85 million, but it took the CEOs having to be like gold stars in order to raise that money. They had to understand their business, their markets. They had to present beautifully. They had to convince the investors that what they had was going to be successful, and they were able to raise. One of the things that most founders don't understand, there's a rule of thumb that's happened in the industry over decades. And the rule of thumb is it takes 90 days to raise. And when I hear that, I have to smile because it doesn't take 90 days. It might take 90 days from the time you have a term sheet from an investor for them to go through the due diligence until you get a check. But even the due diligence process has lengthened because, again, that wariness comes in and they want to really drill down. So 6 to 12 months is pretty typical for a Series A raise. 12 to 20 months is pretty typical for B and up. So you have to have the perseverance and the money on the balance sheet and the expense spending, the burn rate, in order to be able to wait as long as you need to wait to bring that money in. And I think fundamentally one of the critical pieces that comes up to raise money today, you need to have the expertise to raise the money. Now, you could have done it 5 times in the past, and now you're doing your 6th round. That's expertise. But fundamentally, most founders don't have that. So my recommendation is find someone who's got the expertise that can guide you, who's done this hundreds of times, who understands not just the raise process, but the investors and the board and the client companies and everything else that comes into play to really ensure that you've got all your bases covered. I tell my founders when I'm coaching them through presenting, at some point, I'm going to poke them enough and ask them hard questions that they're going to get angry. I want that. I want them to take the eraser or the theoretical eraser that's on the chalkboard behind them and throw it at me rather than get angry at an investor. Because even if they don't grab the eraser to throw it at them, the investors see that in their body language and their voice. Yeah. I would much rather have them get angry at me and then say, Bob, you seem a little pissed about that. What's going on? You asked me that question 4 different times and I thought I answered it. Well, you didn't. So let's go over it again. I want them to be able to get in front of the investor and just be unfazed no matter what question comes up. And that's what's needed to raise money today.
Thank you for sharing that. There's some fantastic lessons for our audience. And moving on to a similar point, the National Venture Capital Association 2024 yearbook, Brett, indicated that there's roughly in the VC community marketplace, $312 billion of dry powder. That's money waiting to invest. And as I was noticing, that money is there, but interest rates have also been increasing. So that's expensive money for funds to have that's not deployed. Is that an opportunity for CEOs, or do funds still going to be real reticent to deploy that capital?
VCs, venture capitalists, have a dilemma when we're in a situation like we're in now. And you just articulated well what it is. There's a lot of money on the sidelines. Some of that money is being used to fund existing investments to keep them going, to hopefully get them to the point where they can exit. So part of that money has gone there. But fundamentally, the limited partners that put that money into the VCs want a return. And they want a good return. They don't want 4% or 6%. They're looking for a VC kind of return. So the VCs have a dilemma in that if they leave the money on the sidelines, right, what are they going to get from that money? CPI, the consumer price index, inflation kind of number, not going to satisfy the limited partners. They have to invest that money, but they're scared to invest that money because things are not happening as fast as they want and things are taking longer and all of that. So it's this balance that a venture partner has to establish between seeing as many client companies that they can, screening those companies to ensure that they're throwing away the ones that have no merit or can't raise money. And I have to be really careful there because VCs make mistakes all the time. There's not one VC partner that you can ask who has not made $1 billion mistake. They're not infallible. They're really good though. They're just not infallible. So finding those good companies, ensuring that the CEO and his or her team can hopefully take this forward, and then putting the money in for as long as it takes to do the diligence and convince their partners that this is in good investment and move ahead. So VC partners still need to invest money. And that's why I said a few minutes ago that I raised 2 very successful rounds last year. You can still raise money because the VCs have to provide the return. What happens if they don't? Well, if the venture capital firm doesn't return to the limited partners what their expectations are for that round of money, it's going to be, I'm going to say, very difficult, perhaps impossible for them to raise their next fund because they didn't do well in the current fund. So VCs have a real impetus to do well for their limited partners so that they can get the next fund funded and continue to grow and return money and bring all these amazing companies to market that are helping change the world in a variety of ways over time.
Thank you, Brett, for sharing that. And just one quick follow-on question is, you mentioned the limited partners have this expectation for a VC type return. What's the range of a VC type return? And I'm sure it's not one number. What's the range there that you're saying?
It is a range. And it's fascinating if you go out and look at the stats on VC returns. There's a lot of numbers thrown out there about what VC returns are. And let me go back to the A round to let you look at it from the VC's perspective on an individual company basis first. So when a founder comes to me and says, what kind of valuation do I need to have to exit? Well, fundamentally, a VC is looking for, let's just say 10x to 100x return on a Series A investment. Now, really, they're looking for 100x or greater, but they can identify at the A stage, the Series A round, which company is going to be an 8 or a 10 or a 50 or a 300x return. So they're looking for that 10x, and hopefully 1 out of 10 of the companies in which they invest will return the entire portfolio. Most companies that venture capitalists invest in don't do well. The numbers are 60, 70% fail. And there's then 30-ish%, depending upon where we are in the chain here, that do what I'll call middling. It's a 2% or 3% or 4% return on investment over time, but not what that venture investor needs to return the portfolio. But that 1 out of 10 or 1 out of 20 or 1 out of 8, if you're Kleiner Perkins or Andreessen, they do better. Those particular firms return higher. So average return, if you look at VC returns, someplace in the 7 to 15% range is pretty typical. You'll hear numbers thrown around at 20 or 25%. And if you pull back the covers and drill down to the details, you may find that one company returned that, one of the companies that they invested in, or even more. But the average return in that 7 to 15% range is pretty typical. Once in a while, you'll see a higher return. And once in a while, unfortunately, you'll see a lower return.
Thank you for sharing that. Thank you for sharing that. And one last question on the industry before we pivot back to Broadscope is McKinsey & Company in an October 2021 report talked about the IPO market and how they're getting larger over time in the first 2 decades of the century. And I just want to ask, do larger IPOs equate with a longer, more expensive process for CEOs to go public?
Absolutely. And I touched on that earlier, especially with what's happened over the past few years with COVID. COVID, because it has lengthened the time for things to happen. And what I mean by things to happen, let's put some more data behind it. Revenues to increase to the point where we're in the $100 to $200 million range is typically when an IPO might happen. So for the revenues to get up to those kinds of numbers, it's taken longer. And if a company can continue to get funded to facilitate growth, because high levels of growth require typically infusions of capital. You can't grow a firm typically based on cash flow. The profitability is not there yet as you're in those high growth phases. So those companies are looking for cash inflows to continue to grow at the high rates. And what are high rates? Well, 100 to 200% is pretty typical in the early years, 50 to 100% in the little bit later years, but still capital demands are required. So if a company can continue to get funded by late stage venture capitalists as they go on, then that is going to lengthen the time for the IPO. It's also going to increase the IPO value because now instead of revenues being, let's say, 100 million after year 5, they're now at 230 million after year 7 or 8. So now the company is more valuable. They're going to be able to garner more in an initial public offering, sell more shares or higher price per share, however you want to look at it, and therefore bring in more capital to continue their growth. It used to be the rule of thumb was VCs, venture capitalists were looking for an exit in 3 to 5 years. And anybody who was in the industry 15, 20 years ago knew that that was kind of not true. That's what they wanted, but it rarely took 3 to 5 years to exit. It was more like 4 to 6. Nowadays, when a client comes to me and says, I want to raise money and I want to exit, great. The conversation is, it's probably going to be 5 to 7 years before you can exit, and companies are taking longer. So this is why I mentioned earlier with regard to the secondaries market, where companies are raising funding as they get further into their or closer to the IPO stage so that they can start paying off some of the initial investors and so that they can start giving some cash to people who have either founded or have been really sweating a lot and putting a lot of time into the firm in order to give them some reward. So yes, CEOs are going to have the perseverance of a longer burn before they're going to be able to exit. And, guys and gals that are our age, if I were doing a startup today, I would be saying, wow, I'm going to be how old before I can exit? Is that something I really want to do? And it's one of the reasons why a lot of the startup founders out there are in their 20s. The 2 rounds I raised last year, one of the founders, the CEO, was in his late 50s. And the big round I did last year, that CEO is in his early 60s. Now, he has been a successful founder and exited in the past. So he knew what he was getting himself into. And he's done a phenomenal job. But yes, it's going to take a little bit longer. And family's going to have to deal with that. Spouse, potentially, partner, kids, whatever, because as it takes longer, founders are putting in more time into the business and potentially less time into families. And, you have to make that negotiation and say, is this okay for everybody involved?
Yes, it is. It's something to think through. Well, thank you very much for sharing that. A couple questions, just back to Broadscope industry experience there. Can you let us know, we had a real interesting conversation earlier about how you screen and vet companies as possible new clients, what you're looking for. Could you share a couple of those with us?
Sure. And I've changed this over the years. When I first started looking for clients, I was in my early years much more open to taking anybody that was willing to hire me to help. And I think we all get into that stage if we have our own business, and whether it's marketing or it doesn't matter. But I don't do that today. I look for a few things in the client companies I'm going to work with. The first thing is the product or service, I'm going to use product from now on, but same thing. Is the product viable? And do I think it's got legs? In other words, do I think this thing can really take off? Now, if somebody came to me and looked at me and said, wait, you're essentially doing what a venture capitalist does. You are screening, looking at that founder and that product to see if it might be successful. The answer is yes, that's exactly what I'm doing. And after 36 years of doing this, I believe I've got a pretty darn good handle that if somebody comes in and I can't come up with a compelling case for customers in an hour or two, or don't have a gut sense that there's one there, I'll tell the founder that. I'll say, look, I think what you've got's kind of cool, but I just don't see that it has legs. It could be because I don't see a market potential there, that there's not a good product market fit and that there's not going to be enough potential companies buying the product. Could be that. It could be that the competitive situation is really challenging. If you came out today, I've got a scissors on my desk. If you came out today with another pair of scissors, I mean, how many companies make scissors? Hundreds. So what's so special about your scissors that's going to compete with them, which is the one that's in front of me, and Fiskars and all the other scissor manufacturers out there? So that's a piece. You've got to have a compelling case for customers' potential, but you also have to have a way to protect that compelling case for customers. I'm putting a moat around it so that if a competitor wants to get in, they can't get over the moat. And it used to be patents that would allow you to do that. And today, patents are far less valuable than they were in the past. So compelling case for customers, moat, really big deal. That's the first thing I look for. The second thing I look for is, does the CEO have the chops to take this thing forward? Steve Jobs is used as an example a lot, but Steve Jobs is one of those incredibly rare founder CEOs who started in the garage building this machine and took Apple to a point, left or was forced out, came back, and then took it to the next level. That's rare. So I'm not looking at the CEO to take it to the Jobs level, but I am looking for the CEO. Can they at least get it through the Series A round? Because that's what the CEO is going to need to do. You can change out the CEO after A. It's hard to change out the CEO before A. So that's the second thing I'm looking at. The third thing I'm looking at is the CEO coachable. Now, CEOs almost by definition, I'll use by definition, have to have an ego. You can't start a company without having an ego. I've got something new. I can make this happen. That's a good thing. But that ego can't blind them to seeing what's going on in the marketplace, to seeing what's going on with competition or customers or investors or employees. So they have to be able to be humble to the point where they can take in inputs. And if they're hiring me, they have to be able to take my inputs. If they won't take out my inputs, John, I can't help them. So I pass. And then the last thing for me is a screening criteria. They have to have some money on the balance sheet. And the reason is it's going to take us 6 to 12 months to raise that A round. So they come in with that 90-day raise in their mind. Bob told me he raised money in 90 days. Well, good for Bob. You're not Bob. The chances of that happening are super low. I've done it. I've raised money in less than 90 days once in my career, and I've helped a company get acquired in less than 90 days once in my career. But it's not a norm. So I'd like them to have about $350,000 on the balance sheet so they've got enough cash so that they've got the runway that's needed with their monthly burn rate so that they are not going to run out of cash before we can get them funded. So those are typically what I'm looking for in a startup. And Am I wrong? Yes, sometimes I'm wrong, but I'm pretty good at my picks and pretty good at choosing the companies out there that really have a chance.
Right. Well, thank you for sharing that. I think it's important for CEOs to know how you're looking at companies' business, and others in the industry are going to look at them through a similar lens, although it may change a little bit. Those are still critical factors and thresholds that the CEO is going to have to meet moving forward.
Yeah. I'm always looking at my client companies as if I am the investor, because that's how the investor's looking at them. So I want them to have that experience from day one. Why did you tell me that? And they need to be able to provide an answer. It's going to be great because of this. Or how come you had a failure last year? And what are you going to do differently now? That's the kinds of things that the investor wants to know.
Right. Thank you for sharing that. Throughout your career, how did you identify Broadscope's unique features and value proposition in the market? As CEOs can go to a lot of companies, can go a lot of different sources to be able to raise capital.
Yeah. So when I started working with Lynn, I was a babe in the woods. I mean, I was 35, but I was still a babe in the woods. Actually, I was a little bit younger than that. But fundamentally, when I got in to start working with him, I realized I knew a lot, but I really didn't know much about raising money and about it, helping a company get funded. And when Lynn and I got into raising money for companies, that happened because of the context and the history that brought us there from our Fortune 50 work and the dot-com boom happening at the same time. So it was he and I learning, what is it going to take to raise capital? And I started in this business building financial forecasting models, very detailed monthly workbooks, what are called bottoms-up models, starting at how many widgets are you going to sell? To whom are you going to sell these widgets? What's the price? What's the cost of every component in this widget? And how are the components going to scale over time and the costs reduce? So financial forecasting and financial modeling helped me at that time really start to understand how businesses work. Because what I found was, as I was building the models would have me start to ask questions about the business that I didn't know to ask before I started coding. And as I got into start coding and realized, oh, this is very capital intensive. At what point do we need to replace this piece of equipment or do maintenance on it, or the myriad of other variables that come into play? I realized I could ask incredibly sophisticated questions to learn about the business and then help the founders figure out what's the path to make the business successful and scale. And then, of course, how to get familiar with building PowerPoint at the time, which were a lot of words. Nowadays, PowerPoint with a lot of words is an anathema. You do not want a PowerPoint deck with a lot of words. You don't want investors reading a deck. You want to show them a graphic so that in 5 seconds, they understand what's going on. They may not understand the variables behind it, but they see what's going on that slide. So that experience at starting at the granular detailed level down here, and then being able to step up to the strategic level with the financials, and then being able to step up to the overall strategic level with the story and presenting the deck and figuring out how to bring this company to the investors in an exciting way, that really started the process. And candidly, when Lynn retired after he and I had worked together for 10 years, I felt pretty good about what I was doing, but I didn't know at that point in time, did I have the chops and the expertise and the perseverance that I thought I had to continue on my own? Right. And, it probably took me another 5 years, 8 years to get to the point where I felt that I had what it took. And now I know I do. There's no doubt in my mind. I mean, somebody comes to me for help. If I think the business is helpable and we can raise money, great, I'm in. And I'm not doing it from this high level. Let me back up a minute. There's one type of firm out there called an investment banker. And investment bankers typically do mergers and acquisitions transactions. They buy and sell businesses. Some investment bankers raise money. And investment bankers do really well at raising money in the $150 million range and up, because they've got a really big Rolodex over here, and they can introduce you as the founder to multiple people in their Rolodex and hopefully make that happen. Investment bankers, however, typically don't dive into the company like I do and work on the business strategy, the capital raise strategy, the financial deck, the pitch deck, and the pitch. So when you look at people out there that are looking at raising money, investment bankers are one, but they're typically used for much bigger raises. For the smaller raises, smaller $150 million and down, or $100 million and down, you really need somebody to go into the company who's got the broad experience across a wide range of domains and who's got the depth of experience, who's done this all the way from seed all the way up to IPO to help you with the round. And that's the kind of person you're looking for when you're looking at hiring somebody to help you raise the round. And yes, there are many people out there that do it. Fundamentally, you want to find somebody who's done it a lot, who really can guide you, who's also somewhat humble. I tell my clients all the time, take everything you hear about raising money, I don't care who it's coming from, with a grain of salt, including me. Now, normally I'm going to ground everything I say with, this is why I said it. But there's a lot of people out there who've raised 1 round, 2 rounds, 3 rounds, but they've only done it in one industry or in one point in time. You need someone who's got dozens of years of this work throughout dozens of companies to really be able to guide you well in your specific instance.
Thank you for sharing that, 'cause that's critical that CEOs are engaging investment bankers and other professionals to raise capital, that they understand that dynamic in the roles that people can play in the market. And you've given them several tips on the types of questions they should be asking those folks as they're getting to know them about, is this the right person or the right firm for me? So thank you for sharing that, Brett. Real critical.
The person they hire will be their success or their failure. So yes, that screening process that a founder uses to hire the right firm is hugely important.
As you started Broadscope and as you were scaling the business, can you give us an example of a calculated risk or a bold move that you took that actually led to the growth of the company?
Yeah, sure. There were a lot of those over time. We should sit down at some point and
Okay.
have a drink and go over some of the more fun ones.
Right.
But yeah, I think one of the big ones back in the early 90s,
Okay.
when the dot-com boom was really started, one of the CEOs with whom I'd worked and who Lynn and I had worked with for on a number of different deals, number of different startups, started an internet service provider company. And at the point in time, ISPs, internet service providers, were kind of just starting out. It was mobile, modem dial-up kind of business. Anybody who remembers modems? And I'm not going back to the ones where they were acoustic and you put the handset in and they would go, not that kind, but the modem that you put on your desk, and you might operate at 1200 baud bits per minute, and you thought you had something amazing, and it was expensive. So when we were first checking email, we would dial on once or twice a day to check email on CompuServe, and that was a big deal at the time, right?
Yes. Yeah.
So this business started, and Lynn and I were brought in to model an internet service provider because the CEO wanted to know, could this business be successful? One of the VC analysts had come up with this idea that if we bring together a lot of internet service providers, that we could build a big firm and now have economies of scale with both the network, fiber optics, and customer service, and all the components needed to build an ISP. And maybe we could really scale the business and become dominant. So at the time, I had done some modeling, but we went in to build this model. I went in to build the model, and I had a model an internet service provider. As far as I know at that time, nobody had modeled an ISP. So I sat down with 2 or 3 of their top engineers to really understand what was going on with an ISP. And the risk was I had never built a model this detailed, and down to the modem and router and CSU, DSU, the devices that connected the high-speed lines to the infrastructure, and fiber and T1s and DS1s and all the infrastructure. And this was still in its formative stages. So not only did I have to understand and build a model to put all these pieces together, but a lot of the pieces weren't really defined for scale yet. Yes, you could go out and buy a DS3 line that had this bandwidth that was, huge, but nobody had really said, well, if you have one DS3, you need to have a second one for backup. And then how do you bring these all together in the router to make sure you can handle all the traffic that's coming in? And how many modems do you need based on how many customers you've got and all of that? So my risk at the time was I had to build this model that then I had to present to the board of directors that was going to make the decision for they're going to invest millions of dollars in this company or they're going to shut it down. And it took me about a month and a half of a lot of work. The CEO said, I want you to present the model. You built it. I don't know it. And I had to get up in front of the board. I was, 32? And I had to present the business to the board. And remember, the board were like investors at that point. They were investors. They were putting the money in. So I couldn't present the details of the technology. That would have just gone over their heads. Even at that point in time, which I didn't realize, I had to present the exciting case that I was talking about 25 minutes ago. I had to present the exciting, compelling case to the investors, answer the technical questions that they had in a way that didn't drill down into the details, but relieved their fears and got them excited about what was here.
Right.
And 30 minutes, I did the presentation. I sat down. At the end of the meeting, the chairman of the board came up to me. I knew of him. I had not ever met him. And he said to me, that was incredible. What you just presented is worth $10 million. And I said to myself, wow, okay, that's not what I got for building the model. But fundamentally, the investors funded. The company was acquired 4.5 years later for $5.5 billion. And I was involved with that company from day one until exit and built the financial models that ran the company for that entire time. So that was a huge risk. And, I didn't know whether I could pull it off, but I dove in the deep end of the pool and said, yeah, I think I can pull it off. So let's go.
Right. And that comes back to that perseverance that you spoke of earlier.
Yes, absolutely. Because there were times building the model, had I let the overwhelm take over, I would have lost it. But to be able to say, okay, I don't know this piece right now. Let me put that to the side. Let me continue here and I'll come back. And that perseverance got me through that project.
Fantastic, incredible story. Then likewise, Brett, could you share a story or maybe a strategy that was not as successful as you thought that it would be? And what did you learn from that?
Yeah. There have been a number of companies that I thought were going to be successful.
Okay.
And dove in and said, yes, I got this. And they turned out not to be. So real true story. One of them was a company that was building virtual reality glasses. Okay. And not virtual reality glasses last year, but virtual reality glasses probably a decade ago. Okay. So it was kind of on the upswing for buzz. And I had worked with the CEO of this firm in a past company. He was the head of engineering. And he came to me and said, I want to raise money. Here's my idea. Here's what I've got. Would you be willing to dive in? And I spent a while talking to him. I spent a while looking at the product and I realized, wow, this is amazing. I don't quite yet know what the market is, but he defined the market as people who want to watch TV, sports and movies and events, potentially on airplanes, but could be even in the house and have an experience like no other because you put the glasses on and they got the glasses to the MVP, the minimum viable product point. So I demoed the glasses and they were absolutely outstanding. It was so easy to get lost in what I was watching on the screen. And they had taken, I think it was Avatar, the 3D Avatar, and they had put that up and had a demo with Avatar and the glasses. And I could feel myself moving in the chair as things were happening on the screen and things were coming towards and moving away from me. And then with, a pair of headphones on, outstanding. So I bought in and I said, this is going to be amazing. Wow. And spent a year and a half working on that project. And didn't take cash, was looking at shares and stock at the time. And a year and a half or two after the business was started, it might have even been later than that, came to find that the CEO was unable to convince investors that this was going to be a big deal. Investors wanted traction. And traction is this word that's bantered about a lot. People think revenues but traction essentially means that you've got a compelling case for customers. You've got customers that want it. If you've got revenues, great. But the investors at least want to see that there are companies out there wanting to buy this thing. And he could not get sufficient interest in sales or purchase orders or letters of intent. So he didn't get funded. Wow. And at that point in time, the 2 years of investment that I made went, and I didn't get paid. I still have the shares in my safe, and they look pretty, but they're not worth anything. And that was one of those that crashed and burned. Not that the team didn't do everything they could to make it happen. And today I kind of look back after, Meta's got their glasses out, the Oculus is out, Apple's got their glasses out. And if you look at the sales, yes, there are certain places that they're being used, like for aircraft repair, where you can put on the glasses and see exactly what you need to see to do the repair. Amazing. But is the market the, hundreds of thousands of sales of glasses, a month? No. Will it be there someday? Maybe. But this company was way too early. So that
Right.
happens.
Yeah.
It's part of the startup arena. You have to have a
Yes.
great product. It's got to be compelling, and it has to be at the right time.
Thank you for sharing that, Brett. That's an amazing story. You're correct. One thing I want to talk about just for yourself as you're throughout your career, what are your superpowers as a CEO, and when did you discover that you had them? Like, when did that self-realization happen for you?
Looking back, I would say the first part of my superpowers happened at the garage.
Okay.
I'm placed between 10 and 19, although I didn't
Mm-hmm.
know it at the time. I was a kid. But fundamentally, looking back at that period working with Joe and being able to approach any problem and know that I could fix it. And that was just the way it was. It's just, okay, I've got a circuit breaker box in a house to replace. Great. I know how to do that. And if not, I can look up and see, but there was never any concern that I couldn't fix it. It's just what happened. So that's the first piece.
Okay.
And then I would say the second piece is working with Lynn and then taking it to the next step of now being able to look at a business. And like Lynn was able to transmit to me during that first MBA course, I can look at any business technology-wise, marketing, sales, finance, accounting. I can talk to anybody in any of those departments because I understand how each of those departments works in detail technically. But I also know how each one of those departments fits together with the others to create a whole and be able to say, this business is awesome in these areas, but their entire go-to-market strategy is lacking. So if I don't drill down there and help them get their go-to-market strategy aligned and make sure that the CEO knows how important that is and that he or she is driving it, they'll fail. So to be able to have that holistic approach, the strategic approach, and the simultaneously be able to go down into the details and then do this tactic strategy, details, high level, hundreds of times a day with a business, that's really what it takes. And the best CEOs I've found do that automatically. They don't have to be told to do that. They know that to make this business successful, they need to be able to get into the details to ask the questions and to get the right things done. They may not need to know how to code the model or how to build out the NetSuite system or that, but they darn well need to know that without these things down here, this can't succeed. Right. So they really have to be able to get down there and come back up. So the best CEOs are really those that are technical and also can step away from the technology and look at the business from a high level. And candidly, that's hard. Most CEOs that do startups are technical. They're engineers, they're scientists, they're PhDs, they're intimately involved in the product. They know all the technical details about it. But in order to be successful as a CEO, they have to let that go. And they have to be able to take the broad view of now, what am I doing with this and how am I bringing it to market and how am I going to make this successful? And that's challenging. That takes a lot of being humble to be able to say, wow, I don't know anything about a balance sheet. What is a balance sheet?
Right.
I know the income statement, right? I know income and expenses, but what's the balance sheet? How does that work? What does balance sheet even mean? Why does this side and this side have to balance?
Right.
And to be a successful CEO of a startup raising money, you have to understand.
Right. Yes. Critical. Yeah. And just like there's startups, you see some different phases of a company as well. Are you the CEO to get it to that Series A, but you may not be the IPO CEO?
Exactly right.
And you have to be humble enough to think about, my investors are telling me this. Yes, this is my baby, my child, and I got it Series A, B, C. But at some point, if the IPO is the goal in the near future, am I that CEO? And your investors will be very direct, I'm sure, and tell you if you're not that person, if you want that later follow-on capital.
Part of my job, the way I see it, is to raise money for my clients, help them raise money. Part of my job is to ensure that the company has a strategy, that the company has the potential to be successful in the long run. And if I just raise the money, but they don't have a successful strategy, I look at it as if I've failed because the investor hasn't been successful and the founder hasn't been successful. part of that success is not just the strategy, but as you just said, is this CEO the one that can take it all the way? And most of the time, I don't know that up front. Some of the time I do. Some of the time it's a technical CEO who I know is not going to be able to raise the B and may not even be able to raise the Series A. So one of the questions I will ask early is, are you willing to step aside if the investors say, or the board says, it's time?
Mm-hmm.
And I get the answer, you know what answer I get all the time.
Yes.
Oh, yes. Well, of course. Yes, I'm willing to step aside until the moment happens where I sit down with them and I say, Bob, remember that question I asked you two years ago? It's time. Here's why I said that. I've been coaching you for 2 years. We've been working on this. Here's the last board meeting that you attended. Here's what happened. It's time. So CTO role, it's typical. They'll step into. It's not typical that they'll step into a chief marketing officer role because they don't have those chops. And it's not typical that they'll step into a chief operating officer role because they don't typically have the operations experience, although sometimes. But yeah, that's a question that comes up, and it's an important one.
Right.
You know, as I'm looking at the exit, which is always my vision into the future. Startup comes to me, I'm looking at, where is the exit? Is it there? Is it there? Is it behind us? Where is it? And then what is it going to take us to get there and be successful? Mm-hmm. And that's part of my job as I look at it for being hired to help them raise money and build a company.
And I would dare say is listening to you, Brett, that part of what makes you distinct and Broadscope distinct is a lot of fundraisers do not view it that way. My job is to raise you the capital and the funds, and you've got to execute. But you've got to execute. We've got 2 jobs here. You want to execute, you execute. But I think, at least from listening to you, I would say what makes you different is kind of that follow through. Is what does the exit look like? That whole follow through process here. In this case, what does that exit look like? Is it to a strategic? Is it to another fund, et cetera? I mean, is it management team buyout? But whatever it is, that liquidity event, that exit, and you helping them getting there and really building that model by month to get them there. Most folks just say, I've raised you the money, Bob. I've done my job. We've got our shares or commission. We're here as a resource. I'm on to I got, a pipeline to get to. Good luck to you. We've done our part.
So let's be clear. So the answer to that's yes. And I am not becoming the CFO or the COO, and
Correct.
I'm not in that company because my business is out here, right? I'm working here, but I'm also looking here and here for the next company that needs my help.
Yep.
I will tell you, however, that 85% of the companies that hire me to help them raise the money keep me on for another 1 to 3 years after we raise the money, because they saw the work we did to raise the capital, and the CEO sees, I want to be able to pick up the phone and call Brett and say, I've got a board meeting coming up next week. This is my challenge. What do I do? Help me handle the board meeting. Or I'm raising my C round. Are you going to be available for my C? Repeat business is big. I mean, the 2 jobs I'm working on right now are both repeat clients, because not only were we successful with the raise, but both clients had me on after that. And both clients see, okay, we need help again. And I know what Brett does, and I need him here. I want to get this round raised as quickly as I can because I dramatically decrease the time, and they want to increase their chances of the raise. And those are the 2 fundamental pieces that I bring.
Fantastic. Well, Brett, thank you for joining us here today on C2 Biz Growth, Iron Sharpens Iron. And I know that our audience and CEOs have gained a wealth of knowledge from listening to you, and we look forward to further conversations. Thank you.
Don, thanks so much for having me on. I really enjoyed spending time with you so far, and looking forward to continuing that into the future. Take care.
Thank you for listening to the C2 Biz Growth Iron Sharpens Iron podcast. And check us out on social media, share, and subscribe.